Hi everyone, welcome to our Financial Markets Market View presentation. I'm Fazlina, this is Jane, and this is Jeff. We will start off with the objective and discussing the economic indicators and analyzing the factors influencing the exchange rates. The objective is to analyze what will happen to the exchange rate of these currencies in the next 3 to 6 months, using different economic indicators and understanding how these indicators affect the exchange rate. Today, we are going to present the currencies between the AUD against the USD and the GBP against AUD. AUD is the fifth most traded in the world. The current inflation rate is 1.90 and the current interest rate is 1.50. Sterling is the fourth most traded currency in the foreign exchange market. The current inflation rate is 2.90 and the current interest rate is 0.25%. The United States dollar exchange rate is the USD. The current inflation rate is 1.94% and the current interest rate is 1.25%. These are the economic indicators. First, the relative inflation rates. Second, the relative interest rate. Third is the relative economic growth rate. As you can see from the graph, the demand is inversely related to the value of the currency and the supply is directly related to the value of the currency. The exchange rate for a currency is determined by the buying and selling decision of those who trade in the foreign exchange market. An increase in export and a capital inflow from the rest of the world will result in demand for a currency. An increase in imports and a capital outflow from the domestic players will result in supply of a currency.
Currency pair we will analyse is the Great Britain pound against the Australian dollar. As of the 20th of September 2017, £1 sterling is equal to 1.684 Australian dollars. As of August 2017, England's current inflation rate stood at a rate of 2.9%, which is well above the government's 2% target. Whereas Australia's inflation rate is currently standing at 1.9%, which is under the Reserve Bank of Australia's target. With Great Britain's inflation rate higher than Australia's, there will be less demand for exports as the value of the Great Britain pound decreases. This means that there will be a decrease in demand for the pound sterling and a greater supply for the currency. Due to the fall of the value of the pound, the cost of imports has increased, thus increasing inflation rates. This also comes at a time after the referendum when the inflation rate stood at 0.3%. With the United Kingdom's inflation increasing along with its economy, it is expected that inflation will continue to rise. Therefore, the value of money will continue to increase compared to last year, as the public will now be able to spend more and receive more at the same time. Following the Brexit referendum, the United Kingdom's economy faced an immediate decline. Currently, according to the Guardian newspaper, the interest rate for the pound sterling stands at an all-time low of 0.25%. The United Kingdom's interest rate hasn't risen in 10 years and further decreased from 0.5% to 0.25% in August 2016. Great Britain's central bank, the Bank of England, has set the rate so low to encourage households and businesses to borrow money and encourage banks to create money to keep money flowing in the economy. Thus, foreign investors are less likely to continue to trade their assets, as a low interest rate means that it is less profitable to invest. With negotiations regarding Brexit being stalled, the country's inflation rate unsteadily rising and falling, and a high unemployment rate, it can be argued that Great Britain's base rate will remain at 0.25% for the next couple of months. But it can also be argued that the interest rate will finally increase for the first time since 2009, as long as the United Kingdom's economy continues to recover from a sharp decline. Regarding the Australian dollar, the interest rate is currently standing at a record low of 1.5%, which is still significantly larger than Great Britain's. With a larger and more competitive interest rate, corporations are more likely to invest their funds into Australia compared to the UK, as a greater interest rate means greater return on investment. This means that the value of the dollar will increase, as there will be an increase in demand and a decrease in demand for the pound sterling, as it is less beneficial to store money in the UK. The United Kingdom's vote to leave the European Union has evidently hampered its economic growth rate in 2017. The UK's growth rate in the first quarter of the year was a minuscule 0.2%, the lowest growth rate in the entirety of Europe. According to the UK Office for National Statistics, the most recent quarter, the UK's growth rate was now 0.3%. The graph provided by the UK Office for National Statistics shows that the UK started off the year with a minuscule 0.2% and eventually raised to 0.3%. Meanwhile, Australia's economic growth rate is continuing to strongly increase and has been doing so for the last 26 years. During this period, Australia has not experienced a recession and currently holds the record for the longest period without a recession. Most recently, Australia has seen an average growth rate of 2.5% for 2016 annually. As shown in the graph provided, Australia's most recent quarter shows an economic growth rate increase at a rate of 0.8%. With Australia experiencing better economic growth, demand for imported goods and services will grow at a faster rate compared to the UK. This also means that Australia's businesses' income and job availability grows too.
The second currencies that we will look at is the Australian dollar against the US dollar. According to the US Federal Reserve Bank, the exchange rate for the currency AUD to USD is 1 AUD equals to 0.8007 USD, and the average exchange rate from AUD to USD for the year 2017 is 1 AUD equals to 0.7642 USD. As we can see from the graph sourced from the Reserve Bank of Australia, we can easily notice that from July 2014, the exchange rate of AUD to USD has been declining steeply until January 2016, where it reaches its lowest point as the graph finally starts to incline, however at a slow rate up until today. We will now look at some factors that affect the exchange rate's value of a country's currency. We will first start off by comparing the relative inflation rates of Australia and the US. According to inflation data, the current inflation rate of the US is 1.94%, and according to the Reserve Bank of Australia, the current inflation rate of Australia is 1.90%. Both countries' current inflation rates are below their target inflation rate. As stated by RBA, the Governor and the Treasurer have agreed that the appropriate target for monetary policy in Australia is to achieve an inflation rate of 2 to 3% on average over time. As for the United States, the Federal Reserve aims for 2% inflation rate over time as stated by the US Federal Reserve Bank. Currently, we can see that Australia's inflation rate is lower than the US inflation rate. Hence, Australia is experiencing a high demand for exports in Australia and therefore more demand for AUD, and a low demand for imports in Australia and therefore resulting in less supply of AUD. Factors influencing the inflation rates are the country's economic growth as well as certain exchange rate expectations perceived in the economy. Besides that, the US Federal Reserve Bank and the Reserve Bank of Australia may have certain expectations to its country's inflation rates. As for Australia at the moment, it is currently concerned with its country's weak wage growth. The next factor we will be looking at is the relative interest rates. According to the US Federal Reserve, the current interest rate of US is 1.25%, and according to RBA, the current interest rate of Australia is 1.50%. As we can see from this graph, showing that the RBA left the cash rate unchanged at a record low of 1.50% again this September, as widely expected. Policymakers said the Australian economy is expected to pick up gradually over the coming year, supported by improving outlook of non-mining investments, while inflation is estimated to rise as the economy strengthens. In this diagram, we can clearly see that the US Federal Reserve left the target range for its interest rate unchanged at 1.25%, as widely expected. However, Janet Yellen, the chair of the Board of Governors of the Federal Reserve System, states that they are expecting a 1 rate hike by the end of the year, despite recent weak US inflation readings. The US Federal Reserve sees the target level for the central bank's benchmark interest rate to be in a range between 1.25% and 1.50% by December 2017. The last factor that we will be discussing is the relative economic growth rates. According to the US Bureau of Statistics, US has a 3.0 GDP growth rate in the June quarter of 2017, and according to the Australian Bureau of Statistics, Australia has a growth rate of 0.8% in the June quarter of 2017. As we can see from the graph, the Australian economy expanded 0.8% in the June quarter of 2017, much stronger than 0.3% growth in the March quarter. The solid expansion was mainly supported by strength in domestic demand and export. As for this graph, we can see that the US economy expanded to 3% in June quarter of 2017, beating market expectations of 2.7%. We can easily notice that it is the strongest growth rate since the first 3 months of 2015.
With the Australian dollar continuing to rise against the US dollar, we believe that the Aussie will continue to appreciate against the US dollar in the next couple of months. This is due to Australia's larger interest rate and superior economic growth rate. Regarding the pound sterling against the Australian dollar, we believe that the Australian dollar in the next 3 to 6 months will continue to rise, whereas the Great British pound will remain around its current state due to its low interest rate.